Lee, tell us more about what we do. First of all, why we do it. We're all about research. We're independent researchers. So tell us how this fits into today's context.
Sure. Well, first, thank you for having me and having me over Skype. I think this is great. I definitely agree with Robert. I think AI has a big role to play in the years to come. And what I would like to talk to you guys about today is a little bit of how Morningstar is using this set of tools. But to your question, Morningstar's mission is really to help create great products that help investors reach their financial goals. We've been doing this for a long time. We've got a lot of different products, a great lineup, and a lot of different goals that we're trying to help investors meet. But the one product I really want to emphasize today, and this is probably where AI has had the biggest marginal impact on to date, is on our equity research. So Morningstar has a pretty large equity analyst department of about 120 analysts globally, covering about 1,500 names, 1,500 companies. And that product has been really valuable to a lot of our clients. And I was increasingly getting questions, how can we expand coverage at scale? And the problem was posed to myself and the team a few years back. And we were kind of looking at three different kinds of output that equity analysts kind of generally produce. An absolute valuation metric, like what is the price of this company, what is it actually worth? A relative valuation metric, so being able to understand what the competitive landscape looks like for different companies. And then a report. And so what we've essentially tried to do is to create a little stock picking or stock analyzing robot.
So how do we do it?
Well, so the first, so I hope they're throwing the slide up behind me, but all of this started with an ox in England in 1908, and it's no bullshit. This story is actually going to be pretty interesting, I think, and it's pretty illustrative for how a big class of artificial intelligence, machine learning models work, and they're called ensemble models. And the story that I think best illustrates it kind of goes as follows. So in 1908, there was a statistician by the name of Francis Galton. He attended a county fair in Birmingham, England, and they were putting an ox up on stage for auction. But he convinced the auctioneers that instead of doing the auction, why don't we issue a raffle to the 800 different audience participants and have them guess the ox's weight, write it down on their little raffle ticket and turn it in. And if anybody got the weight guess correct, they could keep the ox and go home happy. I guess an ox was like a big prize back in the day. So it was pretty motivating. So they turned in these 800 guesses, these 800 samples. Nobody got the guess correct, so the auctioneers kept all the money from the raffle and the ox. And Galton, the statistician, kept the data, and he went home and he analyzed it, and he found something really telling, is that he found that if he took the average of all of those guesses, he wound up within 1 pound of the true ox's weight. So very, very accurate guess. And it was completely befuddling. He was bewildered. He wrote a journal article basically saying, like, WTF, what happened? And it took about 60 years until statisticians finally understood the dynamics under which this occurs. You need big crowds. You need each crowd to be guessing independently of one another, so my guess can't be influenced by somebody else in the audience. And then you need everybody to have a little bit of talent. So you need people to know that the ox is smaller than a building but bigger than themselves, essentially. And so what does this have to, how does this connect to AI and what we're doing on equity research? So this concept of wisdom of crowds is actually at the heart of a big family of models in AI. They're called ensemble models, and they're deployed a lot of times for conscious human decision making. So when we're talking about like stock picking or stock analyzing, where it's a conscious activity, we've been trained to do it, we're following a lot of different rules that are either explicit or implicit or learned. So we could be talking about stock picking or movie picking. Sorry, say that one more time.
So we now need to figure out how we come from the ox to the herd of oxes, and it's basically about attributes of stocks which we need to sort and structure and come to a kind of intuitive result.
That's right. Yeah, so we take this method, this ensemble model, and apply it to all of our historical analyst calls, equity research, and all of the data that exists about these companies. And we learn the function that analysts are using to assign fair values or prices or buy-sell holds to different companies. So that is kind of the foundation. That's how we ultimately arrive at an absolute valuation metric, is using these machine learning techniques. But one of the things that we also are doing, and I mentioned this in kind of the opening, one of the other outputs that equity analysts produce is a set of competitors or a set of comparable companies that we should be comparing, comparing one company against. And oftentimes we're doing this today through sector classification, but you'll probably, if you follow any equity research, they typically buck typical sector convention trends and will identify competitors that might be existing in different industries. And so we looked at this from the ground up and built out a text analytics capability that looked at the topics that companies were talking about and identified similarity based on those topics. We're looking at annual reports, 10Ks, prospectuses, Wikipedia, business descriptions, Yahoo profiles, analyst notes, any information that we can bring in-house to understand how companies talk about themselves, to assess who's talking about similar things. And this actually, the idea for this came when we were kind of discussing amongst ourselves, and we were talking, it was over beers, and we were sharing how a lot of our mothers on the team were talking, or would tell us that that whoever we hung out with when we were kids, that we'd start emulating their behavior. So I grew up in Southern California, and I would come home from the beach and I'd be saying, what's up, dude, or surf's up, or let's go Froden, or cowabunga, or whatever. So it turns out the things that you're around, you end up emulating how you talk and the types of things that you talk about. And so we applied this to companies. It seems to work quite well on a lot of our testing. So you can see things like semiconductor manufacturers being pretty close in what they talk about to auto parts and chemical companies, whereas something like financials is broken out as a pretty unique set of topics that they're discussing.
So basically, the cloud which we see in front of us now, it doesn't only structure the attributes of specific sectors, but it also illustrates how different sectors are interrelated.
That's right, yeah. So we break down each company into a kind of an assigned weighting or a derived weighting on 200 different potential topics. So we might see that a REIT is talking a lot about property, but a technology company might be talking a lot about intellectual property. And so these patterns in the words and how we use them are what creates the spread or the dispersion on the graph. And so you can see that, for the majority of companies, there's a lot of overlap in the things that they're talking about, but there is some uniqueness in some segments.
I think we need to pull this back down to the basic question. What you're doing now with your quantitative team, it's not actually something totally different than what our analysts in flesh and blood are doing. It's basically replicating it. It's a synthetical view of companies, and this is basically what our analysts are doing themselves, but this is on a different scale.
Correct, yeah. So the scale that we're operating at is about 58,000 companies, and we're updating all of these statistics on a daily basis and issuing all of this information through smart text reports. So in addition to generating these absolute valuation metrics like a fair value to price or an uncertainty about that fair value and a set of comparative companies, we're also pulling in automated text generation capabilities to talk about how this rating gets assigned, how these fair values are assigned, what's unique about this company, what's unique about the competitors. So we're layering in a lot of information into a pretty standard equity report template, but it's all being done algorithmically.
So basically, we don't throw a black box at our clients. It's transparent. We make clear what parameters are covered by our research, and the result is what you're just showing us now on this slide.
That's right. Yeah, this is one of the outputs. We're also able to roll this up to different levels. So if you think about, we're providing a kind of a fair valuation for every single company out there, and not just the top 1,000 by market cap. We can really look across the globe and see at different levels of aggregation where are the opportunities. And so this was the end of the most recent quarter, looking at the various companies on a market cap weighted basis where appear to be the most undervalued or overvalued opportunities. And generally speaking, the system, it's trying to replicate the views of our equity analysts, and it's seeing a lot of what our equity analysts are seeing, which is that the equity markets globally are pretty overvalued. And just we can also
Sorry, I interrupted you. Go ahead.
Yeah, so we can also do this on other slices and dices of smaller aggregations. So we can look at things like a style box and look across value to growth dimensions, or look across the small to large cap dimension, or any other real type of factor or sorting variable that you want to look at. So economic moat and uncertainty are two of our favorites, but you can use these tools to really identify where are the hot spots in the market and where seem to be relative buying opportunities.
And this is a really great way to enhance our research, because if I have it get it right, then our analysts typically concentrate on the large caps, and by being able to replicate the research they're doing across the world, across all market caps, we are able to talk about the valuations of Indonesian small caps, which our analysts typically would never look at, but which we are able to screen, and we can come up with those style box results that we have in front of us.
That's right. Yeah, it can be applied at any pooled investment level. So I think it's a quite useful metric, and we're essentially, through some of the power of AI. We've been doing this for the last 3-4 years, producing these output and continuing to build on them. But through the power of AI, we're really able to produce equity research at scale, which I think is pretty great, especially since we're keeping kind of the uniqueness of how we're doing it by not trying to forecast returns or forecast prices or anything like that, but trying to forecast how would an equity analyst at Morningstar evaluate a security on the margin. And so I think it's been certainly very intellectually stimulating, and I think pretty useful for our investor clients.
So now let's come to a very difficult question. Now, since we evaluate companies by analysts, what's the difference, or what are the differences between the results the analysts come up with and what the machine comes up with? Are there big discrepancies?
That's a good question. So it kind of depends on the day. So one of the questions I'll connect this to that I get a lot is, do we even need analysts anymore? If we have this artificial replication of equity analysts, why do we keep them around? And through a lot of testing, what we found is that at least the way that we evaluate securities here at Morningstar, the process of how data is translated into an overall assessment can change through time, depending on market conditions and so forth. So we kind of need to be constantly refreshing the model and have it continually be learning from analysts for how, in order to generate good results. So how do the two systems perform? They perform pretty comparably, certainly on the same set of companies. If we're looking at the overlap of just the training set, there's a pretty high degree of accuracy. It tends to be most accurate during most stable periods of time. During exceptionally volatile periods, the process of turning that data into a rating can sometimes be challenged. But in general, when we look at the aggregate performance of these things on either a returns or a risk-adjusted return basis, they line up quite similarly and are generally monotonic from the most undervalued to the most overvalued.
Let me just recap. You just mentioned it, but I want to reiterate that what we hear now from banks, for instance, is that they're laying off a lot of analysts on the brokerage sell side research.
That's right.
This is not what it's about. We're not killing our analysts, we're not laying them off. It's about the machine learning from the analysts and not machines replacing human beings.
Yeah, it's much more symbiotic in that way, and we see that the system is more stable and it's more performant, at least in our testing on our samples.
Okay, I think we can about wrap it up. I'm getting signals. I just told the folks here that they can ask me questions. But if there's anyone who has something on his mind, you can speak up. And Lee is here for another 2-3 minutes. So if you have any questions, please shout, give me a shout, and I'll pass it along, or I can come up with 1 or 2 questions myself again. The audience is quiet. You're welcome. Is there anything you would want to add? I mean, what we do here, can it be replicated across other research methodologies we do, for instance, fund research? How do we leverage this knowledge we have, the process we have, the team we have with you guys?
Yeah, we've started looking at doing this with mutual funds, with ETFs. As probably many of you know, we do a lot of qualitative, fundamental fund analysis, something similar in terms of the size of the team, covering about 3,000 funds. So I think it's natural that we started having conversations about could we replicate this on the fund side and cover more funds on a platform, for example. We have rolled out that solution in the U.S. for U.S. funds, and I believe there will be kind of some different solutions rolling out in Europe and in Asia Pac over the next few months. But it's certainly, I think, absolutely up for grabs to kind of look at doing these sorts of things with other investment vehicles.
Okay, Lee, well, this was very, very interesting. I think it's given us plenty of new insights. I typically report on those things also on the German language website, so the audience here can follow up on what we're doing, and I'm really keen to hear what your newest results are and the things you look at. So thanks a lot, and yeah,
all right.
time. Thanks a lot.
Thank you very much.